In an earlier episode, I brought up this. There's a point of view that I've heard from some practitioners, where they said the idea of risk sharing is ultimately kind of irrelevant for a system where you're trying to supply the financing needs of customers. Because banking over the centuries has developed with the whole idea of how to price risk. The riskier the investment or the financing, then the more it will cost the recipient of the financing.
Yeah.
And so risk sharing is riskier for the bank. Therefore, it will cost more for the customer. Customer doesn't want to pay more, so they're willing to accept risk transfer. They will accept more risk in order to get a cheaper financing. So, to me, that sounds fairly logical.
True. I agree with this. That's why sometimes I pity the banks, and I personally heard many CEOs actually saying the same thing, that don't try to put a cube into a circle. It doesn't go. The proposal which is most feasible actually is to have two types of banks, of Islamic banks. So one is the same one that we have now, which is based on credit and so on. The other one is a pure investment bank. So clients, if they want to invest, or even if they want to get a kind of financing via investment bank, they can still go, as long as they are willing to take the risk. And let's have, so this is a risk sharing, which is an investment bank. And let's have also a risk transfer model, which is the same that we have now, for those who want to get their basic needs, such as houses and cars and machines and so on. So when we have these two models running concurrently in the society, we are not undermining the need of people to get what they want through a commercial bank. And also, we are giving the opportunity for individual and corporate to invest in the investment bank. So, but asking the same bank to do both credit and investment, this has always been a debate since the inception of Islamic banking 40 years ago. So much so that commercial banks have taken the decision to pursue a risk transfer model, and regardless of all the criticism, because to them this is a matter of survival. This is, as you said, logic, and they cannot do much. This is the main reason why murabaha and tawarruq in many countries constitute 80-90% of their portfolio. So even though some banks try to increase the musharaka portfolio, but at the end of the day, the trend is like this.
You're swimming upstream
to
do that.
Yeah, so I totally agree with this contention, and that's why we cannot ask them to, the commercial banks actually, to increase or to have 60-70% of their portfolio based on risk sharing, because the model, the underlying model, the foundation of the model does not accept that.
So your paper identified certain macro maqasid that regulators should optimize, or they should strive to achieve. What are those?
We have undefined about 6 to 7 macro maqasid. For example, we believe that the regulator should focus on regulation that really stimulate real economy or investment or financing the real economy. So real economy by itself, we consider as an objective. Real economy would necessitate real assets, and therefore we are creating a real economy. So this is an objective, meaning to say we should not fall into the trap of the financial economy. We have real economy, we have financial economy. We don't want the Islamic banking to fall into the financial crisis if their financial assets, or if their assets are mainly financial or dominated by financial assets. So far, this is not really happening because all the financing of Islamic banks are real assets. But it has to be stated in the regulations, even though I have seen it in some of the regulations in general, that real economy is one of the objectives of the financial sector. The other macro objective is we have spoken about financial stability, monetary stability. We spoke about financial independence, and of course, creating a value-based economy. So,
what does that mean?
Yeah.
Let me go back a step before we get to that. Financial stability.
Yeah.
Regulators everywhere would agree to that. And they say what we're doing is all geared to achieving financial stability. So what's different between an Islamic financial system protecting stability and the regulators of that kind of system protecting or trying to achieve stability and conventional?
Of course, there is a common ground between conventional finance and Islamic finance, and one of this is actually financial stability, monetary stability. It's just that the way we have to do it has to follow certain principles. For example, we know that all regulations would focus on three major determinants of financial stability. One would be capitalization. Second would be liquidity. Third would be profitability. So any financial stability in the banking sector has to take into account these three major things. So capitalization, this is where you have to look into your capital adequacy, trying to achieve a satisfactory level of capital adequacy. This applies to all. For example, in Malaysia, capital adequacy stands about 17.4%. All the Islamic banks, the average is about 70.4, which is above the 10.5% capital adequacy required by Basel III, which is very good for Islamic banks. Even though Islamic banks may be facing a problem of when you have a Mudaraba account, that means you have to increase your capital adequacy in anticipation of any losses. And all investment account based on Mudaraba, we all know that there is no capital requirement. There is no capital requirement for Mudaraba and Musharaka. But with the possibility of losses, actually. So you don't have something to back up your losses. This is something, despite the existence of this, I would say, risk, Islamic banks in Malaysia managed to maintain 17.5%. Takaful companies managed to maintain 230% capital adequacy. 230%, this is beyond also the required. We believe that this is good. Maybe this is one of the differences.
So that's the end of this episode. We ask our viewers to stay tuned for other episodes that we will upload soon, inshallah. Assalamu alaikum wa rahmatullahi.